This is Chapter 11, Performance Evaluation and the Balanced Scorecard, our last chapter. Yay! There are several topics covered in this chapter, and one topic is looking at centralized versus decentralized operations. So there's not necessarily one right or wrong way to do your organizational structure. It just depends on what works for your company and what the senior management or owners have decided. So if it's centralized, that means the decision making is really at the top. It's with the owner, with the CEO. It's at the highest level in the organization, and it's typically a small type of operation. And some of the advantages of having a centralized operation avoids duplication. It simplifies setting your goals and things like that. However, there are some disadvantages. It takes up a lot of management's time. If you're responsible for everything, it's hard to know everything, so you might have limited knowledge. Customer relations could be strained because if the manager is doing everything, it's hard to be monitoring the employees and the production and dealing with customers. That can be very, challenging. And certainly training, if just training one person, that gets expensive. And sometimes it can cause managers to become stressed, unhappy, and they're just not that motivated and would end up leaving the company. So when you're looking at a decentralization, in contrast to centralized, decision making and planning is delegated to the unit managers, and this could be for a certain geographical area the company operates in. So it could be say by province or by region, it could be by product line, by customer base, by business function. It's whatever is meaningful and appropriate for the organization. When you decentralize, you free up management's time. If you have a manager, say, who's just responsible, say, for purchasing, well, they become more of an expert and develop knowledge in that area. It improves customer relations, it simplifies the training, and it gives managers a lot more in-depth training and experience and specialization in one particular area. It generally does increase managers' motivation and retention. However, on the downside, it can duplicate some costs or assets, and with multiple managers all trying to work towards various goals, you can have some issue with goal congruence. So for example, the purchasing manager, if they're evaluated based on keeping costs down, they may end up buying cheaper quality products, which could end up causing trouble on the production line. So then the production manager is not going to be happy. So there's no perfect system. There's pros and cons, and it all depends on what is beneficial for the particular type of business that you're involved in. When you allocate a responsibility out, you can have different types of responsibility centers. So you can have a cost center, and that manager is obviously responsible for controlling costs. So it can be human resources and accounting, that type of thing. It can be a revenue center, so the sales department, say at Bombardier, they're going to be responsible for generating sales revenue. If it's a profit center, this could be a product line. And then the last one, investment center. Here the manager would be responsible for producing profit and managing the invested capital. When you are developing a performance evaluation system, a company needs to keep in mind that you want everybody working towards the same goal. And it's important to promote goal congruence, to communicate your expectations, to motivate managers, provide frequent feedback, not just once a year when you do the performance evaluation. There shouldn't be any surprises at the end of the year. You should be providing feedback to your managers throughout the year, so that way you can help them improve. And benchmarking is also important. You need to compare the performance of the company or its various divisions to the industry sector that you're operating in. So everything cannot be measured in terms of dollars and cents. So there are some limitations to financial performance measures, because management needs both lag indicators, so what's happening now, what's been happening, so lag indicators. But then lead indicators, these are indicators of future performance. And oftentimes there is a tendency to focus on short-term achievements. So just looking at maximizing the profit for this year, particularly if management is given a bonus based on this year's financial results. Top management needs clear signals that assess and predict the company's performance over the longer term. So you can't just look at this year's operations. You have to think over the next 3 to 5 years as well. So a common type of framework used to evaluate a company's performance is called a balanced scorecard, and it's been around for over 30 years. It's very effective, and it's been used both in the private and public sector, even not-for-profit sector. So the balanced scorecard, it looks at both financial performance and operational performance. And it's very effective because it links the company's goals to key performance indicators. So in the balanced scorecard, there's 4 perspectives. There's the financial perspective, like how do we look to our shareholders? There's the customer perspective, how do customers see us? The learning and growth is how can we continue to improve and create value, so create internal knowledge and continue to help your employees grow. And the internal business processes, here you're looking at what are the business processes we excel at and which ones do we need to improve on. So the 4 perspectives, first of all, the financial perspective, you're interested in the financial results and growth. You're looking at key performance indicators such as, say, return on equity, profit margin, your cash flow. You might want to be focusing on, say, bad debts and lowering debt. Look at the net interest rate margin, reducing your overhead expenses, and having the proper revenue mix. So if you sell multiple products, figure out what is the optimal mix of product, how many units of product A, product B, product C, etc. Should the company sell to maximize its revenue. The customer's perspective, here you're looking at customer satisfaction, customer loyalty. Are they coming back? Do you have repeat customers? You look at retention of key customers. You might want to calculate sales revenue per customer. Is your pricing competitive, and are you offering similar or better quality products than the competition? And look at the quality of the service you're providing. You have to consider customer preference compared to the competitors. Internal business perspective, there's various factors you can track and measure here. You can look at cross-selling products, improving efficiency and minimizing problems. For example, you might want to look at the quality of your product so you don't have as many defective products, and then you wouldn't have as many returns and unhappy customers. Proper customer relationship management, a high success rate in converting business opportunities, fast business decisions and approvals. So if you're taking on new business, you want to have a process in place where you're going to accept that person as a customer and offer them perhaps lucrative payment arrangements, and you need to get this stuff approved in a timely manner, otherwise they're going to go to the competition. And you need to create a work culture that's conducive to helping the company achieve its goals and higher employee confidence. And the last one is learning and growth. So here is making sure that you're developing the critical skills and knowledge that you need to keep pace, because business is always changing, so you need to make sure you're current. You have the proper knowledge management. everybody is provided with strategic information that they need to do their jobs. It's important as well to align personal goals with company goals. So if you have a manager who's really performing well but has been in the same position doing the same thing, they're going to get a little bored, so you might want to give that manager some more opportunities. So you want to keep them with the company, but you also want to make sure that the company goals are being achieved as well. Company growth and turnover, you want to be able to help your employees gain new skills, and at the same time you want to minimize turnover. Turnover can be costly in terms of recruiting new employees and training them. It gets very expensive. And of course, related to turnover is employee satisfaction, because if they're not happy, they're probably going to leave. Earlier we talked about some of the types of reports. So if you are developing reports for cost center, you're going to be focusing then on the budget variances. If you are a revenue center, then you're really going to focus on the sales volume variances. And then a profit center, here you're going to be looking at both revenues and expenses, as well as allocated charges from the service departments. Here you have a decision tree. So when management is making the decision to provide centralized service departments, if they say no, then the sub-units must provide or outsource their own services. But if you're going to have a situation where you're going to have centralized services, then you can charge the subunits for their use of the centralized service departments. Then the next thing you would want to look at is, are these services provided to the other departments free of charge, or is there going to be a transfer price? So are the departments going to be having their costs allocated between the subunits? This type of decisions, it looks simple when you see it in a chart like this, but it can be very challenging because if you have a situation where you are not charging one department for its use of another department's services or products, then there's no motivation for them to be efficient with their use of it. So you really have to be very strategic in thinking about how to allocate out centralized services to subunits in your business operations. So for investment centers, if you're looking at the financial evaluation, you're obviously going to have to look at how much income is generated and how effectively you're using these centers' assets. So some performance measures here would be return on investment, ROI, residual income, or EVA, economic value added. And there are examples of these calculations in the chapter, and this is something you do need to make sure you're comfortable with calculating. So if you're an investment center, these measures will take into account your operating income, your assets, and here you're looking again at your ROI, EVA, and residual income. So here are the formulas, and again, I'm not going to read them all out, but you can see the return on your investment. So what you're really trying to do here is you're looking at your operating income as a percentage of your total assets. So when a company invests in the business, when people invest in the business, they expect to achieve a certain rate of return. They're assuming a lot of risk by investing their money, and they want to have a reasonable rate of return. So residual income, what you're looking at there is how much operating income are you earning over and above your return on investment. So if you're just kind of breaking even, then you might come to a situation where some years you're not even making a return on investment. So ideally, there would be some residual income left. So when you take your operating income and then subtract your return on investments, hopefully there's some space there, and you can be sure that you're going to achieve your rate of return in most years. And the last one here is EVA, economic value added. So here you're looking at the after-tax operated income minus your assets, minus current liabilities, times the weighted average cost of capital. And here you're looking at the income generated for investors and long-term creditors, and promotes goal congruence. And again, in terms of the formula and this calculation, there's examples in this chapter that you should review. Make sure you know how to do this calculation. So that concludes chapter 11, and that is the last chapter for this course.